great to have you joining me today. If you're new here, welcome. I'm Sinead Gleason, Business Solutions Product Lead here at Equifax Canada. And joining me today for our second quarter update on business credit trends is my esteemed colleague, Jeff Brown. Jeff is the Commercial Line of Business Lead in Canada, and together we work on all things Equifax commercial credit. Jeff will be joining us for the discussion panel after the trends. So he'll go into a deeper dive on what has impacted businesses and the Canadian economy this past quarter. So be sure to stick around for that. It's guaranteed to be an engaging discussion. So let's dive right in. All right, so today we will begin by looking at the second quarter of this year and examining some of the macroeconomic trends that influence Canadian businesses, followed by a deeper dive into the business credit landscape. But before we get started, Jordan's going to take a couple of minutes to orient everybody into the On24 platform. So before I get too far ahead of myself, why don't we pause here? And Jordan, could you take us all through some housekeeping items?
Sure. Thank you so much, Sinead. And good afternoon, everyone. Each area within the On24 webinar platform is responsive so that you can maximize or minimize each widget or box on your screen based on your viewing needs. There is an Ask a Question widget underneath the media player, so feel free to enter any questions you may have, and we'll try to address them throughout the session today. In the event that there are too many questions to get through, we will reach out to you individually to follow up in the coming weeks. Today's presentation and some related content in English and French are available for download in the related content area. The session is being recorded and you will receive the on-demand link via email tomorrow. Some additional features you'll notice in the bottom of your screen are reactions, where you can let us know how we're doing. Register now for our upcoming webinar on fraud trends, September 26th, as well as our survey and contact us. Feel free to check any of these out and provide your feedback. We really appreciate it. And with that, let's get it started. Sinead, back over to you.
Thank you, Jordan. Okay, so let's ground ourselves in the larger economic picture that faced Canadian businesses during the second quarter. Canadians experienced another positive quarter for GDP change of about 0.5%. Although we have been noting for a little while that per capita GDP has been steadily tracking downwards since the end of 2022. And we saw that again this quarter in our consumer credit trends. But it's good news to see another positive quarter overall. On the right-hand side of your slide, you can see the impact of interest rate hikes that they've had on corporate profitability. Interest expense has been climbing steadily, and as of the last half of 2023, it outpaced income after taxes. And that is now starting to come back down as the rates have started to also come back down, which really highlights the impact on businesses' bottom line during the elevated period of interest rates. And we'll continue to watch how that trend evolves as those rates hopefully continue to drop throughout the remainder of the year and into 2025. Last quarter, we speculated that once interest rates started to go down, we might start to see businesses seek out more loans, see their profitability increase, and continue to spur the economy. And we will certainly dive into that as we progress here today. But we still do see that profitability line continuing to trend downwards. And on the right-hand side of this slide here that you're seeing, we examine the rate of job vacancies. You know what, actually, it's been a while since we've looked at this slide, so let me orient you here again. When we look at the overall unemployment rate, it has been trending upwards, but when you split that number out by age group, it's evident that the younger Canadians are the ones that are actually more impacted by rising unemployment. That cohort are impacted by a decline in part-time or seasonal work. And on the right-hand side of the slide, as I'd mentioned, is the job vacancies compared to the average hourly wage. Now, when the lockdowns all ended and Canada was opening back up for business, we saw the cost of labor, or rather that hourly wage rate, begin to increase. And as job vacancies began to come back down again, back to pre-COVID levels, that rate has continued to go up. So on the one hand, there's job shortages, which is largely affecting younger Canadians. And on the other hand, Canadian businesses are impacted by ever-increasing labor inputs. And the rising population that Canada has experienced over the past couple of years is likely adding a bit of fuel into that mix. So definitely a tougher environment for businesses and consumers alike in recent quarters. Okay. And what about the cost of goods? So we know that for consumers, the consumer price index has been on the decline. And in fact, I think just yesterday, StatsCan announced it declined to 2% as of August, which is a relief for Canadians' wallets. But if you look at the cost of bringing goods and services to Canadians, that trend, it kind of has me wondering if we'll begin to see a bit of a reversal of the CPI trend in the coming quarters. You know, we typically see when there's a period of lower industrial prices, which is the red line in that graph. Shortly thereafter, we see a drop in CPI, which makes sense because as prices get lower to produce goods and services, it has an impact on what consumers pay. And conversely, when the IPPI increases, so follows CPI. In 2003, the industrial price index saw some pronounced declines, which helped to bring that CPI level down overall. But you'll notice that those two lines now meet up. So we'll have to keep our eyes on that, and hopefully prices will stabilize on inputs, which will bring us back to a period of stability. And what's driving the increase in industrial price inputs in the last quarter? The increases were mainly due to increased cost of food, as well as primary non-ferrous metal products. Those products are inputs for things like construction, electronics, manufacturing, and transportation. And later on in the webinar, we will examine how those particular sectors are doing this quarter. And CPI has been impacted by mortgage interest rates and the increasing cost of putting food on the table. Both businesses and consumers saw relief at the pumps this quarter, though, which is very good news for both commuters and transporting goods back and forth to their destinations. Okay, retail sales now, those continue to remain flat, and consumers have reduced their monthly credit card spend. This reduced spending trend, even in the face of increased population, highlights that businesses continue to have to work even harder and harder to earn their share of consumers' disposable income. You know, but not only that, it illustrates a tough environment for new business starts too. You know, it's easier to invest and grow in an environment of low consumer debt levels where consumers have more capacity to spend. But in an environment like what we see here, it's definitely a tougher sell. Okay, if you joined our Consumer Trends webinar last week, you might remember this slide. So one thing that we wanted to look at this quarter is the economic impact of natural disasters and climate change. Now, we're just looking at wildfires here, but you know, there's a growing list of events that are way more severe than they've typically ever been. You know, everything from flash flooding in Toronto and Quebec, a tornado in Ayr, Ontario, hailstorms in Calgary as some examples. And these events, as they increase, we're beginning to feel the impact on not just consumers, but also businesses. So the Insurance Bureau of Canada reported record high claims this year, and in some cases, businesses have closed. Looking at the wildfire specifically, in 2023, it was Canada's worst year on record in terms of destruction to land. Unfortunately, many fires didn't actually fully extinguish over the winter, and they reignited this year. Alberta, BC, Saskatchewan, and the Northern Territories have already seen extensive damage above the 10-year average during 2024. And my colleague Rebecca Oakes last week, she mentioned that the Federal Reserve Bank of Philadelphia performed research to model the wider impacts of smoke and fire to regions. And what they found was that for each day of smoke exposure, you can see a drop in quarterly GDP per capita of around $7 Canadian. On top of this, for regions affected by the fire itself, there are higher levels of net migration. House prices fall, and for certain consumer segments, missed credit card payments rise. And so for businesses and lenders alike, these realities pose additional considerations to ensure that they are planning for disaster response and forecasting. Okay, sorry, just messing with my PC. Okay, so now time to turn our focus to the credit side of today's content, and we will now dig into the business credit trends. Okay, this afternoon we will see 3 key trends emerge. Debt levels are going to continue to rise. We see financial stress building in key industries, and we are now seeing high levels of missed payments, particularly on installment loans. So let's take a look. So how high is the debt climbing? Well, overall, balances outstanding on financial trades have grown by 12.2% versus last year, and sits now at $33.8 billion. And by financial trades, I mean accounts which are opened at a financial institution and not supplier direct accounts. When we examine the type of credit products, all of the balances are growing in the double digits, with the exception of installment loans. Those balances actually dropped by nearly 3.5%. Balances on cards grew by nearly 17%, and lines of credit balances are up 24%. Mortgage balances, probably unsurprisingly, are up just over 28%. And regionally, we can see that Alberta and the Northwest Territories saw the largest increase in overall balance growth. A positive trend that we're seeing, though, is the number of new business starts. So since the low period of 2022, new business openings have been once again on the rise. Not yet at the levels that we saw in 2021, but as of this quarter, we are on track to get back there again. We did have a strong Q1, and even our Q2 number is tracking towards stronger than in the last 2 years. Summer does tend to be a period of increased new business opening activity. And so the fact that it has begun to temper a bit in the second quarter could be a little bit of foreshadowing for the balance of the year, but that remains to be seen, and we'll keep our eye on that. The overall growth number was tempered by Ontario, Saskatchewan, and BC, respectively. Those regions reported declines in new business openings, with Ontario accounting for the largest drop at 25%. Next, we will look at the 2 different types of credit categories here at Equifax. We break our data down into financial trades and then what we call industry trades or supplier trades. So the first being new credit accounts that are opened with a financial institution. So those are things like credit cards, loans, lines of credit, and the other being new credit accounts that are opened directly with suppliers. New financial trade obligations, which is the gray line, they were flat, and industry trade originations in orange were down this period. This continues a slowing trend that we've been watching since the second quarter of last year, indicating a softening in business activity. We do know that many businesses were focusing on securing new loans with the CEBA repayment deadline that came and went at the end of last year. And that activity has definitely now leveled off. And on the right side of your screen, we are looking at those new originations by our business failure risk score segmentations, again, split by financial and industry trades. And on the financial trade side, we see that lenders are much more conservative in their lending than on the industry side. And although there has been a very slight shift in the light gray bar, it's largely the same this period as this time last year. Within the industry trade segment, you can see the risk tolerance is a bit less conservative with more trade activity in the medium and high risk segments compared to last year. Okay. Within the financial trades segment, We can dissect that data by product, and here we're looking at credit card new originations on the left and lines of credit on the right. In the card segment, we see the slowing of activity that we saw at the total level on the previous slide, with the first quarter actually reporting lower originations than last year. But the line of credit segment is a different story. Now, it's worth noting that the scale is different for these two segments, so the change does look a little bit more pronounced. But where we see the credit levels reaching around 175,000 for cards, the lines of credit amounts are smaller. In 2021 and 2022, the overall level reached between 5,000 and 7,000, but in 2023, that spiked to over 15,000. 2024 is on track to either keep pace or grow, as the first quarter results were actually higher than what we saw in 2023. So this speaks to just the growing reliance on businesses on more flexible repayment options. Okay, here we are looking at installment loans. And throughout the pandemic, we saw an average of just under 5,000 new installment loans each quarter. But as the deadline for CBIR repayment grew closer, that number began to rise and peaked in the fourth quarter of last year at around 10,000. We still see a much higher than average amount of installment loans issued in the first quarter of 2024, sitting at 8,500, but the size of the loan amounts has come back down. Although with a slight lift compared to the fourth quarter. The average loan size was roughly 86,000 in the first quarter, up slightly from 28,000, but back down to what we had seen at the start of 2021. And turning our attention now to the delinquency levels and balances, we see that the number of businesses with at least one missed payment on financial trades declined this quarter compared to the levels that we saw in the first quarter. And the current number of 5.22%, it's only slightly higher than the same quarter last year, which was 5.15. But these are elevated rates compared to what we had been seeing for the last few years. The balances across all products have been on the rise this quarter. Lines of credit and credit card balances have been steadily increasing. And while we had been seeing declining balances on installment loans, this quarter that changed. Balances have increased almost 9% versus Q1. And so as balances grow, we see an impact on the number of businesses overall who have a missed payment on at least one product, the tune of 56,000 businesses, which is an increase of just over 10%. Okay, so let's recap the credit origination highlight now. We saw that business growth had been somewhat stunted, and this is due in part to heightened interest rates, elevated input costs, and a growing reliance on flexible credit products. Higher input costs could put businesses in a position to pass along those increased costs to consumers. And with the strain that we're seeing regarding missed payments, particularly on those installment loans, businesses may want to renegotiate contracts with suppliers in order to secure better terms or bulk discounts. They might even consider refinancing existing debt if rates drop in order to free up some cash flow. Lenders will need to ensure that you continue to evaluate your risk tolerance and strategies to ensure your share of business lending aligns with your goals. Make sure that you know who your best customers are so you can ensure retention, and examine your pre-qual strategies of new small business customers. Okay, so now let's take a deeper dive into this quarter's credit performance. Here we are looking at credit relationships between businesses, credit that businesses have direct with their suppliers. So this quarter, the early stage delinquencies were somewhat flat, remaining roughly at 11.3%. Late stage delinquencies, though, reported a slight decline from the growth that we had seen last quarter, which is good news. And when we break the late stage delinquencies down further to segment out by the age of business, we see an interesting trend appear. Younger businesses are beginning to catch up to the delinquency rates that we see for older businesses. So during that pandemic period, delinquency rates for newer businesses sat around the 4 to 4.5% levels, but that now sits at 5% as of this quarter. And then regionally, we see those delinquencies clear across the country. So every province is reporting higher delinquency rates compared to Q2 of last year, with Quebec showing particularly pronounced increase to the tune of 35%. BC is also reporting a strong increase in delinquency, having grown by 10% compared to last year. Both these provinces are pulling the growth rate of the national average up to 11%, as the overall delinquency rate now sits at 5.7%. And in terms of which industries are reporting the highest increases in delinquency rates within our industrial trades, agriculture, forestry, and fishing saw the greatest growth, followed by transportation, finance, wholesale, and mining in the top 5. But really, the growth was seen across all industries. It is notable that mining has now crossed into the double digits for delinquencies, sitting at nearly 10.4%. And then when we look at the delinquency rates within our financial trade segment, now we're seeing more of an increase than we had seen with the supplier trades. So overall, delinquencies are now sitting at 3.5% this quarter, up from 3.3% in the first quarter. And as well, we're looking at the segmentation of the late stage delinquencies by age of business. We don't see the same catching up that we did within the supplier trades for younger businesses, but we do see a greater increase in the last quarter. So definitely a concerning trend for banking lenders to be aware of as we head into the back half of the calendar year. Okay, and like we saw on the supplier side, the increases are national, but most pronounced in Ontario, BC, and Quebec. The mining sector here floats to the top in terms of increase in late stage delinquencies, which now sits at 3.64%. And then if we look more closely now at the various products that are included within the financial trade segmentation, we see a large increase in those delinquencies, specifically with installment loans. That product in particular rose a full 100 basis points, having gone from 2.6% in the second quarter of 2022 to 3.6% this year. And like we saw in the previous slide, mining really stands out as having experienced the greatest increase in the delinquency rates with installment loans. That grew by a substantial 77%. Okay, so now let's look at insolvencies. So this quarter, we actually saw a nice drop in the number of insolvencies compared to last quarter. But those numbers are still quite elevated compared to, even long before COVID-19 put pressure on Canadian businesses. And this is true for all provinces, but particularly Ontario and Quebec, which we do normally tend to see higher numbers in. So it appears that while the trend peaked last quarter, we still have a way to go in order to get back to the level of insolvencies that we had been seeing prior to the pandemic. And with the economic environment shaping up the way that it is, it may take a little bit more time yet to get back there. Okay. If you joined us last quarter, you would have had the pleasure of hearing from my colleague Anna Bowness, who brought us all through our equipment leasing and financing trends. If you recall last quarter, we saw the Canadian delinquency rates surpassing those of the US for the first time. So again, just this data that we're looking at is our asset-based lending data. And we've been tracking that data since 2005. And this chart shows you the total delinquency rate of Canada and the US for that asset-based lending data. And this chart really caught my eye last time. Well, the good news is that the rates have come back down from that historic low that we saw, where that red line sort of shoots past the gray line there. That was the first time we had seen that. And it is coming down, but ever so slightly. We do continue to see elevated delinquency rates compared to the US. And then this chart is looking at that same delinquency rate, but this is for the late stage delinquencies. And here there have historically been some periods of overlap between Canada and the US, but not like what we saw last quarter. And here we are seeing the rates starting to come down for Canada, while the US actually continues to see growth. And that, again, that's late stage delinquency. Okay. And then when we segment our asset-based lending data by industry, what we're seeing here on this slide is the current delinquency rate on the far right of each of those line graphs compared to that same period each year going back to 2019. So when we dial the comparison points back to before all of the masking up and locking down, each and every one of those industries is showing delinquency rates higher than what they were previously. The transportation sector was particularly impacted. In fact, the delinquency rate that we see here, this period of 2.8%, is the highest we've seen going back all the way to 2009, when it peaked at that time at 3.7%. So safe to say the asset-based lending credit sector is feeling strained, clear across the board, and in some cases, levels that we've never seen before. Okay, and with that, let's recap the highlights of the performance trends for this quarter. We saw supplier trade delinquencies flat this quarter, and newer businesses trending up to the delinquency levels of more established businesses. Financial trade delinquencies were on the rise, particularly in installment loans and the mining sector. Insolvencies, however, are on the decline, which is very good news. Higher cost inputs and reduced consumer spending may cause some industries to prioritize their supplier obligations, putting possible strain on financial trade repayments. Some businesses might benefit from term extensions or refinancing their existing loans to help reduce monthly payments and free up cash flow to keep their doors open. So as lenders, ensure your portfolios are well diversified across sectors and geographies. Evaluate your underwriting practices to align with Canada's changing marketplace, and assess if there are any early warning systems that you can implement to detect early signs of financial distress within your portfolios. And with that, I will invite my colleague Jeff Brown to the discussion, and he will take, so welcome, Jeff. Jeff used to do the trends, so it's nice to have him back. Jeff, can you share your thoughts on what we just saw as we take a look back at the second quarter?
Yeah, absolutely. I mean, it's tough, right? Like we've been going through challenging times. It seems like for the past number of years, and it's difficult when you review some of the numbers and trends that Jay was seeing. That you're just sometimes looking for a good news story. That there's bits and pieces in there, and it's really hard sometimes to make sense of graphs and charts. So that's really what we're going to try to kind of get through here and make it practical to what we're actually seeing, what's in our portfolios, kind of whip out our crystal ball here a little bit and talk about what we think might happen if these trends continue, just so that we can prepare. So I want to talk about the what ifs, the how do I, where is this happening, what are other people doing, and really just kind of cover that. And during this section, hammer us with questions, curiosities. If there's questions within your portfolio or conversations you're having internally as a team, now's a great time to be able to pose those, and we'll kind of correlate back to the trends we're seeing, and really talk about some of the stories there. So like I mentioned, it's really been a tough year, and one of the things that we're seeing is like delinquencies are high, insolvencies have been at record levels. And really to top that off, the city of Jasper went through an intense summer of about 25,000 people being evacuated when a forest fire really rolled through the heart of that city. What I'm going to try to do is talk to one of the closest events that we have as comparison, which was the Fort Mac fire back in 2016. So fortunately for the Jasper fire, it wasn't as large or had as wide of an impact, but it really doesn't make it any easier. So as we talk through this, really consider this is your kind of emergency preparedness guide. As some of these same concepts and reactions will apply to, floods, hurricanes, earthquakes. Just have those images kind of almost printed in my mind of that hailstorm in Calgary. You're looking at people's sidings that just ripped through housing. So, I mean, it's unfortunate, but as we saw in some of the data, the insurance claims have just gone through the roof across Canada here over the next year. So, one of the things you really should take out of this is you have to kind of expect the unexpected. And there's a few things that you can do as a credit manager, as someone looking at strategy, to really make sure that when these events happen, not if, that that you have a game plan in place, that you're taking protections for your portfolio, your business, and even yourself within your job. So my hope is after reviewing this, you'll keep a copy of the deck or recording the session just to kind of help inform your internal teams in an effort to ensure that you have some form of job resiliency or even business resiliency as well. So really what we saw in Fort Mac was there was a bunch of aid that really hit the market, and obviously it was not something that anybody wanted to have to do, but also there was a lot of rallying around within the communities around it as well. And the federal government did whatever they could to obviously protect everything that was happening around the oil sands as well. So, maybe a smaller event compared to the pandemic, but it's a good comparison as well. Is that when things get bad, there's the reactionaries that we have as lenders and as suppliers that you can offer things like deferrals or payment holidays for areas where that there's just something that you have to be able to do. They're not going to be able to make the payments. Businesses there have kind of closed their doors. And so you have to be able to do something. Those are businesses that you want to succeed. They may have been a customer of yours for a year, 10 years, and them personally, that you've gone through and invested in them for that long. So you need to be able to go through and actively monitor and assist where you actually can as well. So one of the first things we look at is really the financial trades. So during a crisis, you as a lender or as a financial institution, you're kind of checking in. And that was what we were seeing in inquiries as well, is that when bad things happen, you're kind of checking in, getting a pulse of what's happening. You're not necessarily going to see it in a trade line or a financial product that's been issued out, but what's really important is understanding kind of what they looked like, that snapshot before that incident happened. Were they in good standing? Were they trending upwards? Were they trending downwards? And it's really going to help understand that, if you have a portfolio of, 10,000 businesses in the province of Alberta, there's a subset that you have in a gray area that we're kind of on your watch list. You may not grant them, a very high credit limit on some of your products or some of your financial services that you have. But at least exactly who needs that support as they go through a really tough time. So really what we see there at the beginning of any sort of incident is basically an increase in financial trades that are asked. So this is that before the federal government or municipal or provincial government steps in, is that they're already kind of requesting for, hey, I need more credit to be able to extend payroll. I need to be able to go through and pivot part of my business. Maybe it's retail and they had to shut their doors down and just rely on e-commerce for a little bit. Or it may even impacted the delivery of supplies and goods. So whatever that case, there's always an influx of demand during any natural disaster where they're going to be calling, they're going to understand what their obligations are and just look for anything that they can do to support. So obviously this will vary depending on the industry or the business, but the one thing that we've really seen put into practice since the wildfire and the pandemic is lenders and suppliers putting alerts and monitors in their portfolio, so they know in advance of any risk in that region or industry. So rather than just kind of checking in case by case, if you have an active look of what your portfolio looks by region or industry, it really helps you understand kind of what you can do. So these measures help deploy things like payment holidays, like I mentioned, deferrals, and really kind of understand any impact that's going on. And why this is important, and we saw this during the pandemic as well, is that, again, locally, municipally, provincially, and federally, there's always like this request for information because they want to know how much money they should set aside, what kind of funding needs to go to that area. And they're going to rely on you as credit managers. Is what do you extend? What do those businesses need? You're at the heart of those conversations, and it's in your own best interest to be able to go through and understand and calculate that relatively well in advance, so that when those calls do come in, is that you can properly inform to make sure the businesses that that we rely on within our economy have everything they need. Not just you, but you really need to kind of step that level up to be able to go through and make sure that they have everything that they need. So going back to inquiries, they typically spike leading up to or following an event as businesses check in. And then they spike again about 9 to 12 months later. And a big part of this is that, we live in a country that's, ripe with seasonality. Construction is going to peak throughout the course of the summer and then really taper off during the fall and winter months, as a lot of the construction that happens is primarily indoors, not on streets or outside. And so typically with any event, there's a pulse check again. If it was a natural disaster, for example, is the likelihood of that occurring during that same season the following year, you've got those battle scars, and you want to go through and check in again. Is how do they compare to where they were last year? Are they stable? Do they still need more support? What does that look like? So often we'll see a comparison 9 to 12 months after an event. So when we look at credit usage, it tells that story as well. Yes, it's a graph that we're talking here too, but you look at Fort Mac, we saw, when we talk about industry trade, that's a way of saying that, hey, small business is buying something like plumbing parts, and they're buying this with a net 30 terms or net 60 terms. And so when we report that out, obviously you're going to see a dip after an event or during an event as well, is that the business can't operate if their customers are affected. Again, with Jasper, we're talking about 25,000 people being moved essentially out of that city for a period of time, and then trying to find a way to get back to normal. So depending on the severity of the event, those trades are really going to kind of diminish here, or the credit usage is going to diminish during that time period. And really what we're seeing with this is that there isn't there's a recovery back to normal, but there isn't a gap to go through and excel. It's not like, hey, we missed out on all this activity last year. Next year's going to make up for it and then some. There's getting back to normal. There isn't a compensation for that missed period of time. So, as you're going through and extending credit or making credit decisions, know that you're not going to go through and necessarily get a spur of that business back. It's getting them back to a level of normal. So if you're going through and investing in these businesses, you need to know that the recovery time for that is going to be over several years. It's not going to be within a 12-month window. So again, this is something that we're just doing the comparison in Fort Mac. But if we were to look at some of the floods that have happened in Toronto, or the forest fires, it seemed to be in every single province across Canada. This is the story, is that there's never a making up for it. There's always just a getting back to a somewhat normal, even though there's those scars that everybody's still living with. So again, when we look at the recovery of Fort Mac, yes, the one thing that obviously did benefit is construction, because there's the rebuilding of businesses, of homes, the infrastructure within those areas as well. So there is going to be a peak there. But again, it's only going to be short-lived as that area recovers. So when we look at delinquencies as well, think of us as lenders. So you're going through, there's a catastrophic event in a city, and you're offering deferrals, you're offering again, payment holidays on credit cards. And the great temporary gaps, especially as, you don't know when that business is going to be able to run again. So it might just be 30 days, 60 days. But after that happens as well, just as we said that there's that peak to getting back to normal, there's going to be a trough of delinquencies that follow that as well. So when we talk about general numbers that Sinead was going through, there was 56,000 businesses in Canada over the past 3 months that missed at least one financial payment. So when you look at that and you compare it to some of these numbers, these businesses, yes, it's unfortunate that event happened, but they are going to have to shoulder more debt and more burden as we get back to that normal. So we're seeing with financial trades and with non-financial as well, as consumers get back into those areas to go through and buy products to get back to life as normal. Typically, we see a lagging with industrial trades outside of construction to be able to get to that level, typically around 80 to 90% within 12 months. And then depending on the event, that 100% within 18 to 24. All right. So really, what can we take out of this? Like I said, want to think about this as your emergency preparedness guide, whether you're a supplier or financial institution. It really, credit demand is going to change throughout the course of when this event happens. You're going to go through and understand that, there could be more lending products that you have to offer, and it might vary. It might be, hey, I need to go through and increase their credit limit for a short duration. We've only maybe ever approved this business for 10,000, but these are extenuating circumstances. And for this niche pocket, maybe that needs to be doubled for a period of time. As well as non-financial demand, recovery is going to take a while to rebuild, depending on what happened there, how remote the incident is, or if it's in the heart of a business or heart of a city that's already going through some rebuild or already incidents that are taking on. Well, the number of businesses that are out there. As we talk about high delinquencies and businesses, insolvency rates, we're losing a lot of businesses at the same time. And so being able to fill that void, depending on the area, the industry, there might not be enough businesses in there to actually go through and satisfy the proper rebuild or recovery of what happened. And again, expected increase in delinquencies. This is unavoidable. So whatever provisions you put in place, you have to be comfortable enough that, hey, this is what my business is willing to do. We know that we're in for the long term. We're not here just to kind of nickel and dime our customers for a 12-month period and just look at our portfolio year to year. That if that's a customer that you've had in business with you for 5 years, that you want to go through and put the provisions in place to make sure that they can still be with you 15 to 20 years from now. Because we all know anytime you try to onboard a customer, it's more expensive to onboard a net new customer than to maintain those are there. So being able to, again, monitor and understand what businesses could use your support and the ones that are, unfortunately, that you have to kind of triage and that they were beyond any sort of support because they were already trending downwards. So understanding who that is based on area, based on industry, when we go through those types of events, you're going to know exactly how to respond. Sometimes responses happen half and fast. You're on a call and there is a special circumstance that a business has to be able to support. So without lender support, delinquencies could rise around 20 to 30%. And it really depends on, again, the deferrals that might be able to be offered by a business. And recovery periods are going to vary based on the credit that's being extended. So if you're on the industry side, again, that recovery period is going to take a longer time. Financial, typically in or around that 12-month period. So that, as you have a line of credit, a mortgage or credit card with those are issued out to those businesses, that recovery time is going to take a bit longer. But again, those businesses that have gone through those are scars that live with them forever. But they're also going to remember that you as a supplier or financial institution did to help support them through that period as well. So look at it in the long term and not necessarily near term. If you're looking at it near term, you really shouldn't have those customers in your portfolio because you're not doing them a service. If it's just transactional and it's you're not doing anything above and beyond, really that's a shame, and that's something that we need to really take a look at as well. As we get into this next section, we're going to talk about trends that are happening in and around just obviously disasters, but really there's an active investment going on within small businesses across Canada right now, and it's a bit different than what we saw during the pandemic. So I'm excited to get into that, and the next topic here, we're going to kind of look at the construction space. So Sinead.
So Jeff, can you maybe touch on when we start shifting our focus towards the industries specifically and looking now, talking about construction, commodity prices on lumber is trending down. And so do you have any insights on what that's looked like over the past few years and how has that impacted the construction industry specifically?
Yeah, absolutely. And it's funny when I think back to discussions we had around the pandemic. Everybody was stuck at home. Everybody was, being a YouTube renovation specialist and going to their local lumber yard to go through and buy things. And the cost of lumber, for example, 4 years ago was almost 3 times what it is now. So if you wanted to go through and add on a deck or build a new bedroom in your house, the cost of lumber is about 3 times what it is today. So honestly, when we look at construction struggling and everything that's going on there, seeing that trend that you showed at the very beginning of your presentation, that price had come down, it's nothing but a good sign for the construction space. So being able to reduce that cost on that commodity really helps those businesses recover as well. we look at the consumer price index versus the industry index, one thing that people don't understand as consumers is you go to the grocery store and you feel like, hey, like this is way more expensive than it was before. And yes, it's true. Inflation, interest rates, working cost of capital. But at the same time, if you look at that variation, you go back and review this presentation later, the cost that the suppliers were taking during that time period was almost double that. So there was a fight for survival for a lot of like large corporations during that time period just to kind of keep things going. So that commodity price coming down is a great signal. That really paired with interest rates dropping. So obviously the construction industry is very much tied to real estate. At any time someone's going to go through and buy a house, they're also going to go through and think about how they're going to renovate as well. And so unless we have that dynamic going on, you're really not going to go through and see a large deluge of construction happening, new buildings or selling.
Yeah. So speaking of, like real estate and house prices, we are seeing, slowly house prices coming down, and even though interest rates are higher than they have been, for like the last several years, those are coming down too. How do we potentially see this playing out? The impact of the house prices and interest rate drops on the construction industry.
Yeah, it's scary, and I think we'll probably have a lot of these conversations over the water cooler at work or at home, and everybody's hey, the interest rates are coming down, the interest rates are coming down, and I will say that what we've been seeing from the Bank of Canada is a very thoughtful response. If we were seeing dramatic reductions in the interest rates, it would create kind of the animosity that we all kind of fear. I mean, the cost of buying a home for net new owners right now is astronomically expensive. And so if you went through and reduced that rate by 100 basis points, you're going to go through, and a lot of people who have been waiting to enter the market are going to go there. It's going to drive up home prices. And at the same time, we're talking about commodity prices on lumber. There needs to be a period of time where consumers are able to actually afford to go through and do updates on their house and upgrades, and before they actually enter the market as well. So hopefully that trend continues on interest rates. Again, the cost of borrowing is quite high. As that rate potentially continues to come down, we will see a recovery in the construction space. I will say that one thing that's a disadvantage for construction is the cost of the equipment that they run.
Yeah, exactly.
You think about like owning a truck or owning an excavator, you're talking about assets that are $50,000 to upwards of $1 million. And when you see a single delinquency or a little bit of an increase in delinquency in that space, it's very hard to recover. Those payments are tens of thousands of dollars. And so again, hopefully there's a slow buildup in the real estate business, in the real estate space, that we have a strong spring market, and then there's a slow ramp up so we don't drive up prices. Because at the same time, you look at businesses that are struggling to pay these bills, it means that there's a lot of businesses potentially exiting. A lot of conversation, I'll get into this in a bit, is what's happening in businesses that are new versus businesses that have been around for a while.
Yeah, definitely. Like we saw, there's been quite a shift in trend, particularly within the equipment leasing sector. So I wonder if maybe now we can transition over to transportation, speaking of equipment. So to set the stage, Jeff, how did the transportation industry fare during the pandemic period?
All right. So again, we're all at home. We're all having to work from home and figure out life. You're not able to go through and spend money at restaurants. You might be doing renovations. But a big part of this as well is that the manufacturing of core products across the globe had really shut down. You couldn't buy, brand new fridge or an oven or anything like that. And when we talk about the transportation sector, it comes in a number of different mediums. So they're going to have different impacts. But really the supply network across Canada has only really started to recover. So again, during the pandemic, there was things that were strange rules that were happening, that anybody who operated a transportation company during the course of the pandemic, if you had to deliver something across border, the US had different rules about quarantine and things coming across, and we did here in Canada. Insurance policies on transportation changed a lot during that period of time as well. And so it made it very challenging to operate a transportation business. Case in point, as the pandemic was kind of playing out, we got pulled into a lot of conversations with municipalities and major cities about understanding, what businesses were being impacted. And obviously, you would think that, it's going to be, restaurants, anything that someone has to go to a location to be able to go through and spend. When we did that, some analysis, we were really seeing that the transportation industry was getting hit pretty hard. So much so that, again, they're not transporting goods. Goods aren't there to be able to move around. And so it was a challenging time, and arguably they have not recovered. It's been 4 years since the pandemic really started, and they're still not back at the levels that they were prior.
Yeah, it's definitely been quite a period of time. Okay, and then I guess lastly, we've got about 10 minutes left in our segment here, so we can shift our focus to perhaps, where are the opportunities in the current market? Can you share your thoughts on that?
Yeah, absolutely. So I know if you haven't been taking notes for the presentation, there's a few things that are kind of tips and tricks as a credit manager to really think about throughout the kind of small business economy and as you're looking at things. So I will say, if you're thinking about a business credit report and looking at it, sometimes credit managers get confused about kind of the opening of a credit report, and they see only a few trade lines in it, and it's they feel like there's not a lot, and the truth of the matter is it's actually telling them quite a bit. So, for example, if a business is truly small, maybe that's correct, and maybe they don't have a lot of relationships. But also actually kind of tells you something else as well, is that if there's no derogatories, it means that if there was ever collection or legal or bankruptcy, you would see it on the file. And we get 95% of the collection agencies across Canada reporting their data to us. Obviously 100% of legal and bankruptcy. So if there was a derogatory or anything negative against that business, you'd see it there. So sometimes, no news is good news on that front. But in scenarios where a business has been around for a while, and there's maybe a suspiciously low amount of trades, well, there's a strong possibility that business is actually being supported directly by the personal line of credit by those business principals. So in scenarios like this, it's critical to be really understanding that relationship that the business owner has with the actual business themselves. So we've had a number of discussions with financial institutions over the past few months, and we've subsequently released a solution that we refer to as Business Gateway. And it essentially enables you to pull both business and the owners at the same time, with the ability to provide kind of an overall risk assessment of the account. So it's an integrated workflow that kind of pulls them both at the same time. But as we go through and we look at delinquencies, it's really important to know that if we're seeing that increase and there's no net new trades on that file, is you really need to understand exactly what's happening on the personal side of that business as well. Are there markers there that you should be aware of that could actually push that business into that negative credit life cycle? So another thing we really look at is the protection, so that inquiry section. So when I talked about businesses kind of checking in, one of the things that a lot of kind of savvier credit managers do is they'll look at who's listed in there. So for example, if you're an auto lender, if you go through and you see that there's the company's in good credit standing and they have multiple inquiries in there, it's high likelihood they're just shopping around and looking for the best price. So this should really inform your finance department about what kind of offers should be put in place. But on the inverse as well, is that negative credit standing and they have multiple inquiries, it means they're likely being rejected and that there's a risk going around there. So in low growth markets like we have right now, it's really an effective way to manage churn. It's just, again, look at your inquiries, look at comparisons, what's there. So I talk about that with auto lending, but the same applies for financial products as well. That if you see a lot of inquiries from your competitors, it means there's something else going on. Maybe they're actually stealing business from you as well. So in the current market, just kind of going back to what's going on in the economy right now, there's this weird paradigm that's happening. So prior to the pandemic, if you're a financial institution, you'd be looking at low credit risk as a bit trades, relationships, and products. But really, since the pandemic, there's been a lot of businesses that have just accumulated a lot of debt. And so that's why we're seeing the delinquencies that we're seeing right now is that consumers aren't spending, they haven't got fully back to normal. Again, if you're in the transportation or construction space, they haven't quite got back up there yet. But really what we're seeing, Sinead showed a slide about the number of net new businesses that are opening up. The advantage right now, oddly enough, is for businesses that are just opening. So as we see businesses actually declining, having to close their doors, carrying an extra amount of debt, there's a white space for net new businesses right now. So they're seeing the opportunity in really that those interest rates going down and knowing that the cost of capital is actually being a bit easier. And they're seeing market opportunities as businesses who can't extend themselves. And, the old adage that businesses have to be spending money to make money. If those businesses can't spend money to go through and create net new products, expand their stores, franchise out at a location, really it's going to be the advantage of net new businesses who don't have that debt burden, who are entering the market with lower cost of ownership of assets and financial products. Another dynamic, again, we'll only have a couple minutes here, is inflationary wages. So what we're seeing in the market as well, as we talk about the transportation space, is, we've seen on the rail side and the airline side here recently that there is a bargaining that's going on. So when we talk about transportation and not quite recovered, it's kind of an odd timing for this, that, the industries haven't recovered, but the people who work in there haven't had wages to actually compensate for what's been happening with inflation and interest rates. So the cost of living has changed. So I don't think we're going to see quite the end of that yet. There's a few other industries that are going to go through that struggle. And it's something to be aware of, is that looking at fair compensation for certain industries and catching up to where things are today. So a lot of things going on that are going to be kind of headwinds for businesses that we really have to be aware of.
Yeah, I would say it's probably like if you're thinking about starting a business, now is the best time to be building your business plan, because there's a lot of, it's a good period to do your research and figure out what's been the struggle in the last little while and make plans to kind of prepare for the future. So it's a good planning period. Okay, well, thank you very much, Jeff. It's awesome every time that you and I get a chance to chat. I always learn so much. So I really appreciated having you come and share your thoughts and share it with everybody here today. And I'm sure that our audience learned something new. I know I always do. And it's nice to have you come and add some color to the data that we show earlier. So thank you again.
Thanks,
and yeah, no problem. And then if all of you watching, if you guys liked what you saw today and you have a thirst for all things fraud and fraud trend insights, please join my colleagues, Sherol Prince, Sarah Gowdy, and Frederick Gagnon on September 26th. Registration link for that webinar is available here on On24, and you can always find it on our LinkedIn notifications. And also at the end of this one today, please take the time to fill out our little pop-up survey that we'll see when the window closes. Let us know what you thought. And as always, thank you everybody for taking the time out of your busy schedules to come and spend an hour with us and learn about business credit trends. Always hope that you've learned something new and that you will come away with information that will help make your business credit risk decisions stronger and your strategies sounder. So thank you again to all my behind the scenes guys that are here. It takes a village to get it done. So appreciate all of that, and have an awesome rest of your day, everybody. And we'll see you again next quarter.